All right. So what happened with all these regulations? Well, the panic of 1907 finally it's gotten so bad that it's beginning to concern Congress so much that perhaps we need to reconsider the monetary system we have in place. Because, as I hope I have demonstrated, the monetary system that was already in place was a really lousy system. Okay, the national banking system plus the unit banking laws were just inherently fragile and unstable. So the National Monetary Commission goes into action in 1907. It's a commission that was asking questions about what the causes of these crises were and how we can solve them. And unfortunately, I think the commission had already drawn its conclusion before the hearings had even started. Okay, but it wasn't lost upon many Americans, even in 1907, that Canada was far more successful than we are. This is a headline from, again, everyone restrain your shock here. It's from the New York Times. Okay, in 1906, this is a headline pointing out how Canada isn't suffering from these problems, and maybe we should. It says circulation rises with crop demands, right? It's that whole sawtooth thing. The New York Times recognizes this and is suggesting maybe we ought to consider getting rid of all of these restrictions and regulations and emulate the Canadian system instead. Well, why didn't we do that? Okay, well, there was a political struggle between the pro-Canadian system, the lobby that wanted to go to a more of a free banking system. They were fighting with the opposite, the other lobby. Their opponents were ironically unit bankers, state governments, and the biggest shock of all, by the way, is the New York City banks. Okay. So the unit bankers and the state governments, that might be self-evident. They had monopoly. The unit bankers in particular had monopolies. They didn't want competition coming into their regions. Okay, their little fiefdoms had been carved out by their state legislatures. The state legislatures don't want monopolies either. They want to keep the monopolies. They don't want competition either, because if you come into their area from out of state, all of your profits are going to go back to the state next door, not to your legislature. So this was a powerful lobby that opposed any lifting of those interstate branching restrictions. And by the way, I think some of you in the room may be more familiar with me than this. I think up till what year senators were appointed by legislatures and not by popular vote?
1913.
1913. Now, I know, but I'm not very familiar with this political subject. I know I've heard a lot of libertarians say it was a bad thing when the amendment was passed. It allowed for the popular vote to install senators. But I think
the difference between the two houses, one for states, one for...
Yeah, I don't know the arguments, but I do know one argument, which is by having senators installed by legislatures, you're going to get congressional resistance to removing these barriers. Okay, because the senator is voting in the interest of their state government, and the state government is saying, do whatever it takes to prevent banks from entering our state from out of state. Okay. Now, I know libertarians generally thought it was a bad thing when the popular vote was allowed to install senators. So this is, I guess, one counter argument. But I'm not trying to make a general statement about that constitutional amendment. I don't really understand enough about the politics of that issue. And then, of course, a big irony is, believe it or not, the New York City Wall Street banks were also against lifting the restrictions. You would think they would love the idea of being able, with all their wealth and power, of being able to move into other states and compete. But the problem was, if you remember that pyramid structure I showed you, the national banking system was really good business if you were a New York Wall Street bank, because virtually every bank in the country was opening a line of credit with you in a deposit account. So they didn't want that system to end. So in the end, the unit banker, state government, New York City Wall Street Bank coalition wins out, and the crappy system remains in place, but they just stick a lender of last resort on top of it called the Federal Reserve. Okay. So in other words, the unit banks, they recognized that they were vulnerable because they were a unit bank, but they didn't want to give up their monopoly. So they said, well, when we get in trouble, just give us someone who'll bail us out. I'm calling a temporary liquidity loan a bailout. That's a pretty strong term, but it is partially true. Just give it someone who will give us a bailout loan and let us keep our monopoly. Okay, and we got the Federal Reserve. They also wanted deposit insurance too, right? That's another form of bailout. Right? With deposit insurance, you're your claimants are less likely to pull cash out, right? Psychologically, they're going to think their money is safe. You guys have probably heard deposit insurance was tried over and over again. It failed, it failed, and it failed. It wasn't passed until the Great Depression. And Carter Glass, who's part of the Glass-Steagall Act, he's most famous for Glass-Steagall during the Great Depression. What a lot of people don't know was he was a huge champion back in the early 1900s of the Federal Reserve because he was looking out for the unit banking interests of his own state of Virginia and the Virginia government as well. So what we wind up with is a fragile, crisis-prone unit banking model preserved, but we have a lender of last resort to provide a liquidity bailout loan during times of crisis. And I don't have time to go into this, but you guys remember in my Great Depression presentation, when the time came, when the moment came for the Federal Reserve to act as lender of last resort, it did nothing. And that's what made a huge factor in making the Great Depression as bad as it was. By the way, the bondholding requirement on the issue of currency quickly became obsolete. So that is one regulation you get rid of because it didn't take long for the Fed to become the monopoly issuer of currency, right? It can basically do what it wants, although it was held to I think a 40% gold backing requirement. And as I mentioned earlier, we had the Great Depression, and nearly 10,000 banks fail. I think I've already pointed out how over the decades after the Great Depression, you see the states are beginning to loosen up a little bit here. Unit bankers won another victory with Glass-Steagall because, and again, this is Carter Glass. He's a major drafter of the legislation. They get the FDIC. The unit banks wanted deposit insurance, although you probably heard, those of you who saw me back in the fall, I do think deposit insurance, given the crummy system that we have, has been a fairly effective Band-Aid. I'd rather the whole system was reformed, but it has worked fairly well. And Regulation Q was also part of Glass-Steagall that made it illegal to offer interest on deposits. So the idea here was we don't want one bank stealing our customers away by offering interest, so we're going to make everyone abide by the same terms for deposit balances, which is 0% interest. With the deposit insurance, the Federal Reserve has to act as lender of last resort less often. We have fewer panics. I do personally think that deposit insurance has been somewhat effective, maybe more than somewhat effective, in stemming the panics. Although the Fed itself, now being the monopoly issuer of credit and currency, introduces a new problem, which is it now is the cause of instability. It starts to create bubbles and inflate credit irrationally, particularly after 1971, which is when Richard Nixon took us off the international gold standard. I don't know if any of you have noticed, but since 1971, we've had 3 record-setting bubbles, and I don't just mean in terms of nominal size. I mean relative to the size of the economy. We've had the biggest commercial real estate bubble in American history in the late 80s. We've had the biggest stock market bubble in American history during the dot-com tech bubble, and we had the biggest residential housing bubble in American history in 2008. I personally think that is not a coincidence. I think it's because the Fed was freed from the last remaining restraint on its creation of money and credit, which was the international gold standard.
Temporarily.
I'm sorry, temporarily what?
Nixon said temporarily.
Freed or temporarily?
Yeah, temporarily suspending the convertibility of the dollar.
Oh yeah, exactly, right. Okay, I was like, what? They're temporarily freed? Boy, you're an optimist. Yeah, no, yeah, you're right. It was a temporary suspension of convertibility in Nixon's speech, right? And we all know what that means when it comes to government. It's like a temporary
Tax.
yeah, or a temporary government bureaucracy, right? Yeah. Now, after World War II, larger banks started trying to get around this interstate branching requirement by creating holding companies, and the holding company would buy a bank in another state, and they would say, well, technically that the Bank of America, Arizona is a different bank from Bank of America of New Mexico, right? So they started trying to use holding companies to get around it. So Congress responded in 1956 and passed the Bank Holding Act of 1956, which mandated a bank company headquartered in one state is banned from acquiring a bank in another state. So the unit banking forces are still strong, even in the 1950s. By the 1970s, we started experiencing the stagflation era, And this weakens Regulation Q because now depositors are seeing zero interest on their deposits and they're starting to look for alternative investments to keep up with inflation. This is why you guys heard the stories about banks offering you absurd things like toasters or whatever to open an account. They were trying to compensate for not being able to offer interest on deposits. And I just for the inflation era, I put Gerald Ford up here with the whip inflation now pin for those of you old enough to remember. Yeah. He thought the win pins were greater than, he didn't know it was the Fed, but that's basically what it comes down to. If you wear a whip inflation now pin, that'll stop the inflation, right? The source of the inflation is more formidable than that. It's the Fed itself, right? Okay. So eventually Regulation Q was repealed with the Depository Institution Deregulation and Monetary Control Act of 1980. It's not a coincidence that it happened in 1980. This is kind of like the twilight, right? Although we didn't know at the time it was the twilight. It's the twilight of the 1970s Nixon, Carter, Ford inflation era. Now, then ATMs are introduced. This further undermines interstate branching restrictions. So ATMs start popping up out of state and people start taking their cash out across state lines. They start making deposits across state lines. So a bunch of unit bankers got together and sued, okay, to stop it. This Supreme Court case. Independent Bankers Association of New York State versus, I guess Marine Midland Bank was the troublemaker, right? They're the ones who started putting out-of-state ATMs, installing out-of-state ATMs. And the Supreme Court ruled that an ATM is not a branch bank. So that was a victory for ATMs and capitalism. Okay? And that's why they started popping up. So piece by piece, these monopoly rents and these restrictions are being chipped away at, okay, by, like I said, law, but also technology. In 1982, Congress allows failed banks to be acquired by an out-of-state bank. And it was a reciprocal type agreement, not to steal the word right from Donald Trump. It wasn't a nationwide thing. Is if banks wanted to enter states wanted to enter an agreement with another state, they could. And between 1984 and 1988, 38 states signed their own reciprocal agreements with other states, allowing a failed bank in their state to be bought out by a healthy out-of-state bank. And then the final nail in the coffin was 1994. So can you believe it? From the founding of the country, we didn't get rid of the last vestige of interstate branching restrictions until 1994. So it lasted 200 years. The Regal-Neal Interstate Banking and Branching Efficiency Act prohibits any state from restricting branching across state lines. And I don't know if any of you had personal experience with this. I saw it firsthand. I just didn't know what it was back then. In 1992, I had a Nations Bank account in Texas, but at home in North Carolina, there were also Nations Banks. That's why I picked Nations Bank when I moved to Texas. I would get paid some days and have to get on a flight the same day. This is before direct deposit. So I took my check to North Carolina, the Nations Bank, and tried to deposit, and they said they couldn't take it in 1992 because of laws, right? Yet I did the same thing in 1996. It wasn't a paycheck, but then I had direct deposit, but it was some other check. And I tried the same thing, and then the Nations Bank in North Carolina accepted the check then. It was only then that I noticed I had complete unrestricted movement of money across state lines, ATMs, deposits, you name it. It was because of this act. By the way, Don Regal himself, he's retired. Interestingly enough, he came out 2 years ago and endorsed Bernie Sanders. I don't know what happened. Yeah, it's bizarre. You need a whole team of psychiatrists to figure that one out. Okay. Okay. One of the great ironies, unfortunately, is that the same act that removed the restrictions and opened the banking up to greater free markets and capitalism also mandated that any bank that wants to expand has to submit to a Community Reinvestment Act compliance review. Now, those of you who know what the CRA is, this is one of the greatest ironies, and it's really sad. So CRA, for those of you who aren't familiar with it, is a law that was passed in 77. It had no teeth in 77, but it said, well, a bank can't ignore these redlined areas where credit ratings are bad. They thought it was racism. So if you want to stay in business, you've got to make loans to these uncreditworthy borrowers. And the banks really ignored it until 1994. The final version was signed in early 1995, right as the Democratic Congress was on its way out. Bill Clinton signed the provisions that put teeth into that act and started imposing penalties on banks, lawsuits, fines. You can't open another branch. You can't merge with another bank. You can't go and do another business like proprietary trading or insurance or whatever unless you submit to this review and prove that you're loaning lots and lots of money to people you otherwise wouldn't want to loan to. And I don't know if you guys have seen this chart. I mean, this is when the rules are going, the new tightened rules go into effect. This is obligations in trillions of dollars by U.S. commercial banks on CRA loans, and it goes up to over $6 trillion. Now, this is an obligation pledge, so the actual amount of loans is some fraction of this. But I mean, even if it's 1/5, $1.2 trillion in lousy loans that banks didn't want to make. And again, the great irony is it's tied to the same legislation. I guess we can believe Bernie Sanders here, right? It's tied to the same legislation that freed the banks to compete with one another across state lines. And some of you may know the rest of the story. I could do a whole presentation on this. The Clinton and Bush administrations launched their national home ownership strategy. Bush's Ownership Society, FHA and HUD are directed to lower lending standards for FHA loans. HUD instructs Fannie Mae and Freddie Mac to increase home ownership rates and push. I've got some real doozy quotes I could find you from Fannie and Freddie during those days about what they were doing on behalf of the federal government. The Fed pushed interest rates into negative real territory for 4 years, and the rest is history, right? We got the housing bubble, right, and crisis. Okay, so this is it in review. This is a good final slide if anyone wanted to see what were the laws themselves. I added a little sarcastic note at the very top. It's a summary of the laissez-faire pre-Fed banking conditions, and you can see the absurdity now, right? You have state-level unit banking, anti-branching laws that force no diversification of loans or deposits. Banks are unable to transfer reserves when there's regional trouble. They can't coordinate their responses to systemic stress. It's a very inefficient, high-cost system that underbanks America and results in scarce credit. We had two privileged central banks for the first 40 years, or for 40 of the first 45 years of the young American Republic, which were allowed to branch nationwide and inflated credit across the entire country and created bubbles in at least 3 panics. And then we had the national banking system, which pyramided credit, banknotes, and deposits atop a smaller base of gold and silver, taxed any bank that didn't want to participate in the system out of existence, required banks to back their banknote issuance 111% by U.S. bonds, and this is collectively what led to the instability that led to the creation of the Federal Reserve. My final slide, and this is Steve Horowitz. I know this is he's a free banker, by the way. It's part of the free banking school. I know it's a long quote, but he's really good at summing up, usually going after Krugman, which I enjoy personally. Okay, so he's talking about Krugman's column. He says that Krugman has a much bigger puzzle to explain. If free markets and banking are the problem, why did Canada, which during this period had a far less regulated system than the U.S., not experience the panics we did? And why did no Canadian banks fail during the Great Depression? If Krugman's criticism of the quote-unquote mythology is correct, the Canadian banking system of that era should have been a basket case. But instead it was a model for the world precisely because it lacked the two most damaging government regulations present in the U.S. Canadian banks have always been free to operate nationwide and were before 1934 able to issue their own currency free of bond collateral requirements. The very free market in the Canadian banking system dramatically outperformed the much more regulated U.S. system. It's a long quote, but I think it's a wonderful summary of what's wrong with Fed apologists like Paul Krugman, who say it's because we didn't have a Federal Reserve that we had all of these crises. Here's some reference material. As just nothing will put people to sleep more than naming off books, but this presentation is available on austrianmoney.blogspot.com if you want to pull it down, and if you want to read more material on this. There's only one here, by the way, which does not directly relate to any of the material in my presentation. It's this last one, A Century of Failure. If any of you are into layman economic statistics, this is fantastic. This is more historical case against the Fed. George Selgin talks for about an hour on the economic failure of the Fed. He looks at all the metrics like unemployment, inflation, GDP, and he compares those numbers before the Fed to during the Fed era, and he proves that even on the economy, the Fed is a failure by its own measure. Okay, this has nothing to do, he talks a little about the instability part that I've discussed, But it has very little to do with that, and more to do with just the economic, the historical, or I should say what, economic historical case. It's not a very good way of putting it, against the Federal Reserve, which is whereas mine is more of a historical case. Okay, this is actually some slides that aren't, and well, opening the floor up wide open to any questions.
Question.
Okay, go ahead, Leo.
What was the original legislation that created the unit bank?
Okay, so the question is, what is the name, or what is the
What was the source of the
original
unit banking?
legislation to create unit banking? And so I don't know any name.
Or just when, or just some history of the source of the unit banking system?
It's, yeah, so that I can't. So it's state to state.
Okay.
So every state is passing it. It doesn't have anything to do with the federal government. And in terms of the time frame, I would love personally if someone had a chart that said here's what year every state started doing it. A lot of this material came from Calamir's and Haber. According to them, they don't give specific dates, but it's basically from the founding of the republic. So what is that, 1787, right? And as far as the latest example I had was the Pennsylvania Omnibus Act of 1814, although for all we know, maybe Pennsylvania had their own other different laws before then. But it's really in the infancy days of the United States is when those laws came about, and they came about at the state level.
I see, okay, that's cool.
Yeah. You know what, one more thing before I take your question, George. Selgin, those of you who arrived early, you probably heard I'm a big fan of George Selgin. Anything Selgin presents on, it's going to be entertaining at least. One of his talks, he does have a picture of the United States with all of the states in the year 18 whatever. So you see they don't go much past the Mississippi River, and he actually has a number in each state to indicate how many banks each state had at that time. So that might also tell us something about when the laws were enacted. Okay, question, George?
I didn't realize how pervasive the unit banking was and for how long. How do credit cards fit into the mix of this? I know that a lot of the companies that were issuing credit cards would incorporate in Delaware because they could charge higher interest rates on the cards by doing it. But how do credit cards fit into this whole picture?
So I don't know. I do know, we all know credit cards in the scheme of the whole history of the U.S. is a fairly recent technology. There's only one partial response I can give you, and then maybe we can go look it up, and that is credit cards are not a form of money. They are not an aggregate in the monetary, in the M1, M2, M3 monetary aggregates. And I only know this because Lawrence White, who, by the way, wrote a book that's in my, if you forget his name, here, I'll give Ron Paul a plug while I'm out of here. So one of my sources, primarily for Scotland, I spelled his name wrong, sorry Larry, Free Banking and Britain Theory, Experience and Debate. If you want to know more about the Scottish system, there's a lot more detail. It's pretty interesting. But Lawrence White was actually invited by Ron Paul when the Tea Party movement happened and the Republicans gained control of the House in 2010. I mean, first of all, Ben Bernanke immediately went out and bought a huge bottle of Advil, okay, because he knew what he was in for with Ron Paul chairing that committee. But Ron Paul would invite Austrians to speak, and Larry White spoke. Tom Woods spoke in front of the committee. I can't remember the name of the committee. And he was asked about credit cards by one of the committee members, and he discussed it and said credit cards are basically, they're an obligation by the bank or whatever, but they definitely are not counted as part of a monetary aggregate. And I know your question wasn't even whether they're a monetary aggregate or not, right? It's like, where do they come into play with the restrictions on, I just don't know. I mean, I'm only thinking about this off the top of my head. There's no reason back then you couldn't withdraw cash from your, they're all Fed notes by the mid-20th century. Withdraw cash, drive across the state line, and buy a hamburger. So if you drive across state lines and use your credit card, I really don't see a lot of difference. So without thinking it through as carefully as I should, just off the top of my head, I'm not sure credit cards did much to bring about the downfall of interstate branching restrictions, but I'd have to research it some more. Okay, we had a question from Richard, and then sorry.
Okay.
So Richard, okay, you had a question?
I just want to know a word or two about the tariff of abominations, which I never heard of before. When was it? When did it happen? What was it supposed to achieve? What did it?
It's like in the 1830s, I want to say. We can check online. I just wrote an article recently. I write for Cautious Optimism. It's a hedge fund guy on Facebook. It's pretty small. He's got about 17,000 followers. But I just wrote a 3-part series on Smoot-Hawley, and the tariff of abominations came up. We can check. I could be wrong, but I wanted to say 1830s era.
Did it have the same effect as Smoot-Hawley, basically? Or?
Yeah, nothing had the same effect as Smoot-Hawley, and I don't think anything Trump's doing is going to have quite that effect either. We'll see, but the tariff of the abominations was a higher tariff than Smoot-Hawley. The worst of all, I think, was the McKinley. I have to go back and check my own article. But the purpose of these, there was like the abominations, the McKinley, there was a Warren Harding tariff. These were all passed under Republican administrations. And back in those days, the Republicans were kind of a pro-business to the point of what we would call crony capitalism, pro-business. And it was protectionism for their favored businesses. That's why they passed those. Yeah. And ironically, the Democrats in those days, again, I know this is a shocker for anyone young or young enough, the Democrats were very pro-free trade. It was a leftover from the Jeffersonian Democrat-Republican Party. And to my shock, when I was researching Smoot-Hawley, FDR, this wasn't in my Great Depression presentation, I learned it afterwards. I know this is getting a little off topic, but I'll be brief with it. FDR, those of you who sat in on my presentation, his policies were pretty much quackery and interfering with price clearing. That's what it came down to, is interfering with price clearing mechanisms during the Great Depression. And he simply prolonged it. But one shocker I discovered was he was unambiguously free trade, and he went to work pretty quickly tearing down Smoot-Hawley, and he had Cordell Hull, Secretary of State, going from country to country, cutting reciprocal free trade deals, one country at a time, to get rid of the tariffs. Yeah, so that's, as much as it pains me, I think FDR needs to be credited for that. It's called the RTAA, if you guys want to look that up, the Reciprocal Trade Agreements Act. Yeah. Okay, Orteo, I hope I'm saying it right. Yeah, question?
Yeah. So everybody agrees that these institutions oppress and don't let flourish a diverse economy, a free economy. So what would be your bet to either bypass or get rid of this, the Fed?
So you're saying everyone agrees we should have, what, a freely functioning banking system or a freely functioning economy, period?
Yes. Is there a way of just dumping this shit?
Oh my God, that would take another, and not only would it take another couple hours, it would stretch into days, because I know some of you personally out there would jump up here, push me out of the way, and want to talk about it too. So I'm not optimistic. I don't think the Fed and the central banks are going away anytime soon. Coincidentally, if you'll allow me, I'm going to plug my next talk with your question. Probably later this year. I don't want to promise a date yet because I haven't started on the slides. I'm going to do a talk on the gold standard, and there will be a section on how to return to a gold standard, which could be a first step in ultimately getting rid of the central bank. But I think the most modest first step I've seen, did you guys hear about John Taylor? I mentioned him in my Great Depression talk. When Trump was looking for someone to replace Janet Yellen, he was considering our current Fed chair, Jay Powell, Kevin Warsh, who was a Fed governor, and John B. Taylor, who's a very, very famous Stanford economist. Taylor is a monetarist. He's kind of in the Milton Friedman school. But Taylor is easily most famous for the quote-unquote Taylor rule, which means that the Fed should not, with its own discretion, be able to print as much or as little as it wants. It shouldn't be able to raise interest rates or lower them as much as it wants. It should be put on a formula. You plug in like unemployment, GDP growth, inflation, and all that, and then the formula gives at most the Fed a range within which they have to operate. And obviously that's nothing near the same as getting rid of the Fed, but I think politically, if we want to talk baby steps, that I can see being the first step. And ironically, the Republican Congress passed a Taylor rule type legislative package in 2015, and Obama, unsurprisingly, he vetoed it at the request of Janet Yellen, Fed chair, advised him to veto it. I think the Republican Congress knew it was going to get vetoed, and that's why they passed it, because now that Trump is the president, they're not passing legislation like that anymore. It's very strange too, right? So I hate to disappoint you. That's about the best I think realistically we can hope for right now. But I do agree we should get rid of the Fed, and I would not have a problem with going back on a gold standard, something highly unregulated like Canada had. Okay, question?
I guess this doesn't relate directly to anything you said in the talk, but the same year that the Fed was instituted, the income tax was instituted. Do you think they were absolutely directly related, or?
They're related, but not directly. This is all the progressive era with Woodrow Wilson, right? I know they were both passed in 1913. Now the Fed opened the stores in 1914. Does anyone know what year the federal income tax actually? I mean, I know I'm implying that the federal government waited, which is insane. Okay, but I wanted to say World War I. Maybe World War I was the excuse for them to use it. 1%. Yeah, just 1%, just for the war, and then we swear on our grandmother's graves we'll get rid of it. Yeah, exactly. But no, I mean, you look at that. There were a couple other major pieces of legislation during the Wilson era. This is why libertarians in general think Woodrow Wilson was one of the worst presidents ever. League of Nations, involvement in World War I.
House?
The President Mandel House?
I don't understand the reference.
Colonel Mandel House.
He worked
Okay.
for he worked for Wells. He was a puppeteer in Wells.
Okay. Yeah.
Kind of like Cheney with Bush.
Maybe you can. All right. Maybe you can fill me in a little of that over overtime sports bar. But like Lawrence Reed, I don't know if you guys know Larry Reed, at Foundation for Economic Education, fee.org. He every year he'll repost the same article saying, "Here's to the worst president in U.S. history, Woodrow Wilson." But there's a picture of Nosferatu the vampire there in black and white. So yeah, not directly. I don't think directly related, but it's all part of that whole era where Woodrow Wilson is pushing for just bigger and bigger government, more intrusion into the economy. Yeah. Okay, any more questions? Okay, great. Well, then maybe we'll pack it up. Let me stop the recording.